Investors are grappling with what comes next for mega cap tech amid concerns about heavy AI spending. Our guest says a rotation out of those big tech names could unfold throughout the year. We're joined now by Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Thanks very much indeed for joining us. Yesterday, the Financial Times had a story that a price war may be emerging in AI. Chinese engines have slashed prices. Now, of course, they may not be allowed into the West, but it's interesting. How much money will people pay for AI, I guess is a question.
Yeah, Andrew, I think that's been the story that we've seen since the end of October, where investors are looking at those valuations and trying to say, how much do we want to pay up for growth? And we've seen, obviously, over the last several weeks here in 2026, software companies disproportionately punished, and then that rotating last week into some other sectors of the economy where AI disruption and concerns started to play out. I think the bottom line, where we are right now is I think investors are in a show me position where they're looking for more clarity from some of the bigger names like NVIDIA, who has earnings next week. Obviously curious to see how this round of cap raising and funding goes for OpenAI and at what valuation is going to be placed on that big name in the space. But I think bigger picture moving forward is that there's been a real focus on cyclical growth in the U.S. and policy support that has moved investors to look at valuations, look at earnings outlooks, which is why value is trading a little bit better than growth. But I think over the balance of the year, if outlooks for growth still hold for some of these major AI names, I don't think technology is technically in the penalty box longer term. But I think we need to be a little bit more cautious and a little bit more focused on allocations over the course of this year.
And broadly speaking, though, U.S. corporate profitability is still growing. I know a lot of that has been and is the big tech companies.
Yes, and so I think that's a fair point, but I think it's also the distribution of growth. So when we look at earnings outlooks for the balance of the year, we're expecting 2026 with publicly traded companies growing about 15% year over year in profit growth, but bigger contributions coming from areas outside of tech due to the impacts of fiscal reform through the tax bill, spending in CapEx, steepening yield curve that should help financials. Healthcare always seems to perform a little bit better in a midterm election year domestically here. So you have a little bit more of a balanced view on earnings growth, and I think the market is sniffing that out right now. I think once we get past the second half of the year and you look at 2027, we see more of a fiscal drag happening within the economy. And I think over the second half of the year, we're going to get a little bit more clarity on this, on the AI innovation investment thesis and that next wave of where AI innovation could play out. So I think in the interim, staying broadly diversified across both large, medium, and small growth and value makes sense until we get a little bit more information. And at the same point in time, I think tech is still a big contributor to earnings, like you said, Andrew, and something that investors should still hold in their portfolios accordingly.
Would you be inclined to pile into big banks, not necessarily talking about these stocks, but the likes of JP Morgan and Citigroup?
I think financials right now is quite interesting. The big banks have had a pullback recently, so there is some value there for sure. And also, I think it's worth looking at some of the regional banks as well, because they'll have more of a contribution to profits as loan growth potentially accelerates with economic activity over the course of the year. And also with a steepening yield curve, they get more of a bottom line contribution based on net profits from loans. So I think big banks with the recent pullback look attractive, but I think also looking at some regionals also makes sense.
And what about the consumer stocks? Obviously, General Mills, a classic defensive consumer name, reporting pressure on consumers. That happened a few days ago, and that put pressure on other packaged goods companies. Are you seeing value there?
Yeah, so the consumer staples and some of those consumer names right now are trading at forward PEs, actually very similar to their peers in the tech space. So I kind of see the consumer staple names actually as quite expensive. And also with the recent data that we just got on GDP numbers and PCE numbers as another key inflation gauge for the Fed, we're seeing that quarter over quarter, yes, consumer spending is holding tight, but it's actually in a decline on a sequential quarter over quarter perspective. So when the froth kind of wears off on these tax refunds that are coming through over the next couple of months, and higher income earners spending a little bit more in tax due to increasing obligations through long-term capital gains, I think in the second half of the year, consumers are going to continue to be very sensitive to price, which is why we're not necessarily looking at following through on this consumer discretionary trend in the short term, and actually looking for areas of value outside of the consumer discretionary and staples areas, such as financials, healthcare, industrials, some aspects of utilities that are kind of playing into the CapEx spending cycle, and also just the changes in the potential yield curve with profits still being durable for companies, as mentioned before.
Brian, thank you very much indeed. Brian Vendig, Chief Investment Officer at MJP Wealth Advisors.